Much like you and the IRA Club, Marshall Reddick really, our cornerstone is education, right? So if you jump on our website, you're going to see hundreds of videos, webinars, recordings. We have got a YouTube channel. We've got articles and guides from everything from 1031 exchanges to how to set up a self-directed retirement account. Hint, hint, go talk to the IRA Club. The agenda today is who is Marshall Reddick Real Estate? What are we doing here? What's in our purview and what can we advise you on? The basics of the fund and how to utilize your self-directed retirement accounts. FAQs, and I'm going to Vince and I are going to bounce questions off each other, almost like we were in a consultation with a client that's asking the very same questions that we field every day. So I'm probably going to answer a lot of your guys' questions that you might have, but at the end of this, a ton more are going to pop up, of course. And we really would love it if you guys scheduled a consultation with us. We'll share our contact information. It's also on the IRA Club's website. And it goes without saying, it's really essential to understand the performance of the fund. We're going to get into the portfolio metrics and then what lies ahead for the fund and how we see the next, not just quarter going, but the next year, 2 years, 5 years. So well, who's Marshall Reddick? So we like to think of ourselves as a one-stop shop for investors that are interested in real estate. So what does that mean? Well, we have 4 distinct services. First is our real estate brokerage. We are very intentionally spread out across the country in 5 different states: Texas, Florida, Tennessee, Kentucky, California. We have offices all over Texas and Florida and Tennessee, like Nashville, Houston, Austin, San Antonio. Because we want to set up shop in areas that are really great for real estate investing. So we've got excellent real estate agents that assist our clients all over the country and all over the world even with acquiring great real estate assets, whether that's just through their own personal capital or even through their self-directed retirement account. Much like Vince, I mean, you purchased a duplex, right, through your 401k.
That's exactly right.
And Marshall Reddick now manages that, and I believe that's in New Braunfels, or
Correct.
New Braunfels, so which is Central Texas. But so we've got agents trained to do that and underwrite deals. But if you've purchased real estate, you probably know only 10% of the whole deal is the acquisition side. 90% of it is the operations side, because you're going to have that real estate asset in your portfolio for maybe 10, 15, 20 years potentially. And so you got to have a good property manager. So we've got property management teams set up in all of those markets where we've got our real estate brokerage offices. And we now currently manage 3,000 doors across those states, which is pretty fantastic, a big milestone for us. But these other 2 points are really why we're here today, which is to discuss private money lending and our investment fund. So we are a private money lender, meaning we lend funds out to borrowers that maybe conventional financing isn't their first stop. It's private money for a variety of reasons. So think flippers, think wholesalers, developers, those that need funds through their self-directed retirement account that want to purchase real estate. We're going to lend to them as well. You may be in a unique position where you own 11 properties and you can't qualify for conventional anymore. So we're going to talk about in more detail the types of borrowers that we lend to, but the other side of the lending is how we raise capital that we lend out, right? So that's through our mortgage fund, where we raise capital from our capital partners, and those folks get a really nice, healthy, safe, and stable return via the fund from the interest that we collect on the mortgages, and of course the origination fees that we collect whenever we originate a mortgage in the private money lending department. So that's in a nutshell what we do here at Marshall Reddick. And of course, the investment fund is really why we're here, which is to talk about why you might want to invest in the fund. And of course, I take a lot of pride in this picture. This is our team that's always expanding, but we've got Vince, who's in this slide, who's been with Marshall Reddick for over 5 years, and we've got some employees that have been a part of Marshall Reddick for 20 years. It's a young, growing, really vibrant, amazing team. Diverse, not just in the way we look, but diverse in our expertise and experience. We've come from all over the country and world with our real estate backgrounds. So we've got to other offices, but this is our core office where we do all of the in-house underwriting.
Chris, just so you know, I'm coming by. My mom and dad actually own a house in Dana Point, so I'm gonna.
Oh yeah, man, you're next door
Yeah,
neighbors with
I live in
Vince.
Dayton Point too, so that's great.
Oh, there you go, Vince. I didn't even know that. So
Yeah.
great.
Well, I'm gonna hand it over to Vince to just go over the fun basics here, and Vince, I'm gonna apologize on Vince's behalf. He's got a little bit of a cold right now.
Yeah, so we're fighting through it. So bear with me if I get into a cough attack here.
If he's got to leave, I'll interrupt. But Vince just had a baby, a son, and I'm sure he's fighting with battling colds all day long. So
that's right. So thanks, Chris. A little bit more about the fund. So what is the Marshall Reddick Mortgage Fund? So as Chris mentioned, we have a very active private lending department, and within that private lending department, there's direct lenders, and then there's the mortgage fund. So like an example, if somebody wants to fund a direct loan, it's one borrower, one lender, right? So you're taking on the risk of that one project. But why would anybody want to go with the fund? Well, the fund, you're spreading your risk amongst hundreds of different loans, right? So basically what it is it's a private debt fund, and it's from accredited investors. And we're lending it out to the folks that Chris touched on, right? Flippers, people who are borrowing in their self-directed retirement accounts, people who have more than 10 finance properties. Those are all great examples of people that borrow from us. We are strictly loaning in first lien positions. So no juniors, no seconds. So that really helps keep the security and the safety of the fund intact. In addition to that, we lend at very low loan to value ratios. And it's for non-owner occupied scenarios only. So no primary residence is allowed. We are distributing a quarterly distribution every quarter. So that's been an amazing thing that we've been able to, issue to all of our investors. And there's basically two portions of our return, right? So there's a preferred rate of return of 6% annually. And then there's a profit share component. That profit share component ranges anywhere from 50-50 to 60-40 to 70-30, depending on your capital position. We'll go into that breakdown in more detail, but that's the kind of high level of what is the fund.
Awesome. Thanks so much, Vince.
In addition to that, so how does the fund make money? What is it that we're doing? So the fund earns loan fees and interest, right? So we charge origination fees to all of our borrowers, anywhere from 2 to 3%. And then we charge interest anywhere from 10 to 12%. So that, when annualized, gets us a return anywhere from that 12 to 14%. Now, our target net to investor is 8%. We have basically been able to meet that goal every year, exceed that goal, meet or exceed every year since inception. So as I touched on earlier, the two components, the 6% preferred return, along with that profit share. And then Marshall Reddick, as the manager, we do have a 2% asset management fee, as well as we share in the other side of that profit when there's profit available. There has been profit every quarter since we've started the fund.
Absolutely. Just a couple of basics while Vince is taking a little sip of water here. I'll give his throat a break. But we have a $25,000 minimum investment and a 12-month minimum hold. We really want to make this accessible to any accredited investor, so you guys can dip your toe in this, understand the space, get comfortable with it, and of course, go up from there if you'd like. Earnings are distributed quarterly. You can automatically reinvest or just take cash out. We have some folks that have big positions in the fund, and that's kind of their retirement earnings, right? Now, regardless, earnings are taxable, and then big yellow and bold asterisks and underlined here, except for self-directed retirement accounts. So that goes hand in hand with what Ramez.
Ramez, you had a question?
Yeah, Chris. So I just want people to understand that the majority of you that are listening, I would say about our audience, Chris and Vince, I would say about as a 70-30 split, accredited to non-accredited, because the majority of individuals that actually utilize retirement dollars are accredited, but our members have grown substantially in the non-accredited world because more and more people are getting wind of self-directing. But I don't want to discourage those that are listening that are non-accredited, because you also do have something else that maybe later on, if there's enough time, if we could go to your website to explain, there are other strategies that you offer to non-accredited investors. Correct me if I'm wrong.
No, that's absolutely correct.
Yeah.
for those that are just looking to expand their real estate portfolio, we are positioned really well in markets like San Antonio, where I invest, Austin, Southwest Florida. It really, whatever market you're looking for, we're going to dive deep into the details, run pro formas on properties, connect you with really good agents, and you can do that through your self-directed retirement accounts or just through your personal capital.
Okay, so
anything to add there?
a question just popped up. Are you guys licensed to practice in all 50 states? Was question one, followed up by question two. Does Marshall Reddick provide coaching and advising services to first-time investors or ERC?
So as far as licensed in all 50 states, we're mainly from a real estate standpoint operating in those 5 states. When it comes to lending, there's a much larger list. We're not in all 50, but technically there's very little restrictions that would allow us to move forward in a market. So it's really going to be, if we're going to start in a new state, it's really going to be a factor of that borrower and if that's going to be something that has legs for future, right? So we can kind of go into more detail if you have folks that are looking to borrow in other markets. As far as coaching and mentoring, that's exactly what we do. We do that every day, right? So as far as our webinars, our just conversations that we can have, that is the kind of foundation of Marshall Reddick, is coaching and education and helping people along the way. Not just sending you off to other service providers. We are also that service provider that can implement that coaching that we're talking about.
Thanks. Yeah. Jeff also asks on your previous slide, can you repeat the fees? I see that there's 2% management fees. What is the profit share that you guys retain?
So the profit share is either going to be depending on the tier. So at $500,000 or below, it's 50-50. For $500,000 to $3 million, it's 60-40, 60% to the client, 40% to Marshall Reddick. For $3 million or greater, it's 70% to the client, 30% to Marshall Reddick.
And we'll get into the nitty-gritty of what those returns look like based on the performance of the fund for 2024, depending on your position in the mortgage fund, right?
So hold your horses, Jeff. They're getting
Jeff, we're going to get to it, I promise, and we'll show you what your return would be if you had $3,001 in the fund, right?
By the way, Chris, I know who that is. That's why I said that. So no disrespect.
Awesome.
Cool. And then just to kind of close out here, the automatic, basically when it's time for distributions, you can take those quarterly distributions in the form of cash or reinvest. That's a really critical component for Roth or for IRAs, right? So I have a solo 401k with a Roth component. So I'm invested in the fund through my Roth. So those quarterly distributions are compounding. So I feel as though that's a great home for that, to get that compound interest. Because oftentimes when you collect those distributions, it's normally not an amount that you can, has enough teeth to go do another investment with. So to build that up large enough to then, if you ever want to deploy elsewhere, this is a great strategy. And then as far as redemption, basically, we have 90 days after the 12-month period. We have 90 days to redeem per our PPM. The last 2 redemptions that I've done were issued out in less than 30 days. Just to kind of finish some bullet points here, the mortgage fund is a California partnership. You will receive a K-1 at the end of the year. It's important to talk with your tax professional about this. As Ramez touched on, there is no UBTI in the fund.
And why can you just touch upon why that is?
So the biggest component is it's an unlevered fund. There's no leverage, right? This is all private capital that we've raised. So being that there's no leverage in the fund, allows this fund to, with no UBTI. Down the road, we may have funds that have leverage, which we would have to note that, but this one is a great home for those that are avoiding UBIT and UBTI that you guys touched on recently.
Yeah, just a couple of points here, just some high level overview. As of October 1st, we got 60 million total investor capital. Our returns based on the 50% profit split with reinvestment, since inception, it's 8.55%. Year 1 was 8.3. Year 3 was 8.3. I mean, what we're really trying to illustrate here is just the consistent returns that we've been aiming for. That was the entire kind of the purpose of the fund originally was to have a home for consistent returns outside of what the stock market's doing, outside of how real estate's performing. So we've had 19 operational quarters with corresponding earning distributions that have exceeded expectations.
Okay, great.
Yeah, so I really want to just we're going to answer probably some questions that might come through. And I'm going to sort of give play the hat of the individual that might be looking to invest with my IRA. So my first question for Vince here is, can you just tell me what private lending is and why would I do private lending versus potential other asset class? Yeah.
So, here's the definition that we have for private lending. And I like to say, we've touched on this already, but I always like to describe private lending through examples of borrowers that we work with. Like we touched on earlier, it's going to be your fix and flippers. It's folks like you at IRA Club, right, that are looking for non-recourse debt. I always like to use myself as an example. As an individual that has a solo 401k, I was able to purchase a duplex within that solo 401k. I did not have enough capital to purchase that property cash, so I needed leverage. Marshall Reddick is a perfect example of a service provider that can offer leverage to those that seek, that want to buy real estate in their retirement account.
Yeah, and we're one of there's very few non-recourse lenders out there, and we're one of them. And you need a non-recourse loan within your self-directed retirement account.
So that's another example. I'm an example of a borrower. And then, like we touched on earlier, those that don't meet conventional guidelines, and it's not because of poor credit or no income. It's because typically of maybe guidelines like they have more than 10 financed properties or whatever it may be. So this is just kind of a high level of who we work with. And it's, a lot of these borrowers that we particularly work with, we've had long existing relationships with. Chris, so to further this, do you specialize in any specific type of private lending?
Yeah, absolutely. So non-owner occupied. So Ramez, you're not getting a house in Dana Point and borrowing money from Marshall Reddick if it's for your primary or secondary house. But we do definitely lend to those looking for real estate investments. So non-owner occupied must be a first lien position. No differentiating tranches of debt, has to be first lien. And it's always secured, obviously, against a real estate. But specifically, it's ranging from 1 to 4 units. So 80% of our portfolio of the loans that we have outstanding right now is single family homes. There's a few, duplex and fourplex developments in there. But we intentionally select single family due to the high liquidity of it. It's easily tradable. And historically, it's a lot less temperamental when there's recessionary trends. So we really like single family, and that's going to be our continued focus when it comes to private money lending. Once again, we'll mention this: non-recourse for self-directed retirement accounts, but it's recourse for everybody else. Yeah.
So show of hands. To those of you that are I'm going to take one step back. Chris, Vince, one thing that you guys don't know is IRA Club receives 1 to potentially 10 phone calls a month and our members are always asking, can you leverage against a retirement account? And the answer is always yes. Then I say, you guys would have to go out there and do your due diligence to find a bank or a private lender. So you guys will eventually, a month or 2 later down the road, will call me back and they're like, well, nobody lends against a retirement account. Well, 99.9% of banks across the country do not like to leverage against a retirement account. Why? Because it's a separate entity from who you are, which is the reasons why it has to be structured as a non-recourse loan. So Chris and Vince are one of the rare companies out there, private lenders, that will leverage against an IRA. Okay, that is a very, very big deal. Just an FYI, wanted to point that out there for those of you that are listening that have actually called the IRA Club and you guys are looking for a non-recourse lender that specializes in retirement accounts. Here you go.
Yeah, thank you so much, Ramez, for clearing that up. And I think you could be looking for a whole month and, like you said, not find a non-recourse lender. So we're one of few. And the great thing is we have a very big footprint because we lend in many states. So depending on your strategy.
Question just popped up. So what is the interest for the non-recourse loan if you use retirement dollars? Great question.
So those rates can range anywhere from 8 to 12%. It depends really what kind of loan you're doing, right? So the longer terms, non-flip loans are going to be on that lower side, where those flip loans are going to be on that, higher 12% size. That's going to be acquisition and renovation dollars. So, and this is the thing that I want to let everybody know, since we're talking about the borrowing side. While we do have guidelines, it's private money. So we're not selling this debt to anyone else. There's always conversations to be had. There's always unique scenarios. There's always maybe adjustments that can be made. So if there is at all any interest, we can show you where you can find all the rates and terms and loan products. But in case there's any more dialogue that needs to happen, we're happy to go into that.
Yeah, definitely.
Chris and Vince, on a separate note, when we're done with this webinar, can one of you reach out to me? I would love to put this part of your presentation as a resource for those that are looking for leveraging against a retirement account. I would like to add that to our resource center.
Absolutely.
So a lot of our clients are always asking, can you point us in give us some sort of place that we could look or find? And so this is a great opportunity for you IRA club clients.
Yeah.
And we've touched on this many times already through the presentation, so we'll just kind of breeze through this. But these are, like I said, these are the examples of most of the folks that are borrowing from us.
And it's just, I want to put a fine point on this. The folks that are like the flippers, right? It's not some Johnny come lately off the street that got an idea from Bigger Pockets, not to denigrate Bigger Pockets or anything, but someone that just had an idea that said, I want to flip a house because I saw an HGTV show, right? The folks that we lend money to are very seasoned professionals that we've built relationships with over many, many, many years here at Marshall Reddick. To reiterate, we've been around since 1979. So it's guys with the HGTV shows that we're lending money to. I quite literally partnered with a amazing team out in Hawaii that's got a great TV show that we lend money to through our private money lending department. Now, what is an accredited investor, Vince?
Sounds like most of the folks know here. So I don't want to spend a ton of time here, but basically income of a single filer of 200,000 or more. If you're filing jointly, it's 300, or a net worth of 1 million or greater, excluding the equity in your primary, right? So that's everything else you have, right? Stocks, bonds, mutual funds, retirement accounts, and we have providers, whether it be a third-party accreditation. We have forms where you can have your CPA or financial advisor fill that out, or that's basically the.
We make it a pretty simple process, honestly. It's something that you guys can get done in a couple of days with us if you're looking to seek becoming accredited for the very first time. But this is a question that I think is essential, which is if you invest in the mortgage fund, how is your capital protected?
Yep. So a couple of points here that we want to touch on. First and foremost, it is by focusing on it's a collateral-based lending, and we focus on low loan to value. So the current aggregate LTV for our fund is 62%. So we feel like that puts us in a really strong position where there's a lot of borrower equity at stake. In addition to that, we're only doing liens in first position, no juniors, no seconds. That's also very important. We also like to diversify our risk across the country. So there's not any one borrower, any one market that has, all of our loans. So it allows us to spread that capital amongst many, many different borrowers in many different states. And then we originate 100% of our loans in staff. So this is our full-time underwriting team. Like Chris and I mentioned, oftentimes they have long-lasting relationships with these borrowers. We have a zero tolerance policy for those that end up, kind of burning us or doing anything that's, unfavorable to the team, where, we're not willing to continue to do business with folks like that. So that's what's allowed us to be so consistent and so successful in our private lending, is by being a very rare resource and being able to make sure that those borrowers are meeting all the demands that we need.
Yeah, absolutely. And that picture illustrates just how many folks we've got here in the office that are underwriting loans and really being analytical in the investments that we do make within the mortgage fund.
Chris, just really quickly, what is the LTVs and what are some of the loan programs here?
Yeah, so we'll encourage you guys to jump on our website at marshallreddick.com. You can look at our rate sheets if you're interested on the borrowing aspect, but the folks that we're lending out to, we require at minimum 10% down. That's probably going to be more if you're a flip on a short-term loan, and 70% maximum LTV on the ARV after renovation value. What's really key to note for the flippers is that renovations are funded through reimbursement style draws. So what that means is the person that we're lending money to that's flipping a property, they've got construction they need to complete. That first phase, there might be multiple phases. That first phase of construction, they're taking money out of their own pocket. Let's just say it's $25,000 to complete, the flooring renovation and kitchen renovation. They have to come out of pocket for that and then reimburse them through that draw after we receive pictures of all the improvements, the permits, the invoices, the fact that the contractors have been paid, all that good stuff. So we're very careful in how we release funds. And then when it comes to long-term loans, 70% maximum LTV for purchase, 50% maximum LTV cash out refinance. We certainly can talk about DSCR ratios and all that stuff, but I think that might be better left for a different conversation one-on-one with you guys. And where can folks find out more? I think this is something that we really like to pride Marshall Reddick in, which is transparency.
So truthfully, we can go on we could do a full presentation just on the mortgage fund website. I'm going to have Chris jump over to that very quickly. This is for all of you guys to be able to jump in. So this is going to give you all of the nuts and bolts of the mortgage fund. But basically, the purpose of jumping to this slide is to show you the transparency. We have our return since inception, our capital, currently active mortgages, our historical default rate since inception, structure, purpose, strategy. You'll see all of our documents there, fund managers. But really why I'd like to bring you folks here is this interactive map. This is a really cool map. This is actually showing all of the current active mortgages across the country. So like, for example, if you just click on Nevada, Chris, you see we have 3 loans in Nevada. 52% LTV, total dollars that are lent there, right? And if you click on any one of these particular loans, it goes into a robust breakdown of anything one would need to know about this loan, right? So what kind of loan is it? Renovation, what's their exit strategy, the capital, the yield, the payments they're making. Here's their schedule of releases, right? And if you scroll down further, you're going to be you could click on loan docs and lender docs, all of their plans, their scope of work, all of the parties that are involved. So it's almost
it's kind of, to me, it's designed, if you had someone that is highly analytical, they could underwrite our entire portfolio. It's pretty interesting.
We'll even go as far as to show you the property values and the comps for a sale, the comps for rentals. And this is done on every single one of our loans. So I urge you guys, for those of you that are wondering, like, how safe are these deals or what does it look like? For those of you that want to get into the nitty gritty, you can do this. This is all open to anybody to take a peek at.
Yeah, it's kind of
like all on your website, correct?
Somebody
just all on our website that you guys can look at.
You do not need to be an active capital partner to have access to this. This is open to the public. Anyone can. This is not like taking a peek under the hood. This is like taking apart the whole car and seeing how all the pieces fit together, so you can really dive in.
And just to kind of close, you're not required to know all of these metrics, but if you shall decide to dive into it, we have those financials there for your review.
All kidding aside, I'm about to take this link and add it to Investors Row. Like, take a look, learn more about like what I got to find a spot for this. But I think for IRA Club clients, this is a really big deal. Like, most companies do not do this. So this is a testament to Marshall Reddick. I mean, this is very, very, in my opinion, a big deal of due diligence. So
if you look at a lot of funds, sorry, Ramez, but if you look at a lot of funds, I would urge you to try and find that level of transparency with literally PDFs of recorded deeds and things like that. It's pretty impressive stuff that we provide.
For for those individuals that do decide to move forward, how would one track your investment? How do you find where your capital is, and what does it look like on their end?
Yeah, so we partner with Appfolio, great software service. They've got a fund manager. We provide you with a login, and you can see all of your quarterly distributions, all of your earnings, the total capital that you've contributed. We picked someone that's in the fund that allowed us to, show some of their position here, but this is their last quarter's earnings, historical return, and then you've got your tax documents, tax forms, your K-1s, your subscription agreement, easy ways to get a hold of us if you have questions. Just make it really simple. Honestly, it's very user friendly. And then this is I just think a phenomenal question for anyone to ask in this space, which is, Vince, we have heard a lot about the interest rate volatility. Obviously, it's been evident over the last 4 years. What happens when conventional interest rates change, and how does that impact the private lending space?
That's a great question, and I get that question constantly. In short, conventional rates don't have an impact on the private lending space. So our rates do not fluctuate; they stay very consistent. Our private lending rates are more tied to the competitive nature of other private lenders, right? So the thing that we have to understand as a private lender is we have two clients that we're working with. We have borrowers and lenders. So it's important that we keep the cash in the mortgage fund working at all times. So how do we do that? Well, we have to keep people borrowing all the time. So we have to keep the yield, the interest rate attractive enough to warrant more and more borrowers. But then again, we have to keep the yield to the investor high enough to where we get capital. So that is more of the metric that we have to tug a war with than it is conventional rates. So, despite conventional rates being as low, when the fund started in 2020, our private lending rates were relatively close to where they are now. And as you guys all know, conventional rates today are much different than they were in 2020. And I think our yields and our consistency over the last 4+ years has shown, with that 8+% return, has shown that regardless if rates are in the 2s and 3s or 6s and 7s, our yield has remained constant, and that's because we're just operating in a totally different space.
Yeah, 100%.
So Chris, in lending, there is defaults. That is part of the business of lending capital. What happens if a borrower does default? What does that look like, and what goes on next?
Yeah, it's definitely an ugly truth, right? It's just something you deal with any business, is that you're going to have some losses, hopefully a lot more wins. And we publish our default rate within the mortgage fund. So you can see all of our active completed mortgages and all of the defaults, and you can even look at which property we defaulted on. But the question remains, what happens if a borrower defaults? So we've got a few options to cycle through here. One fact is that just because there's a default doesn't mean it's a loss for the fund, right? So that could be a settlement with profit, where the lender, we, Marshall Reddick, agree to take some or partial interest earned from the mortgage along with the full balance of the principal investment, right? A settlement with a loss would be they maybe pay us, no interest, and then less than the full balance of their principal investment. Deed in lieu, that's just a fancy way of saying they're going to hand us keys to the kingdom. They're going to hand over the keys back to the initial asset that they acquired with the funds that they borrowed against, and we just take the mortgage. So foreclosure sale, that's when we go through the entire foreclosure process. It may take weeks or months, and we have an auction that takes place at the courthouse steps. If there's no purchase at auction, then it's REO, which just means real estate owned. Then it goes back into the hands of Marshall Reddick, and then we dispose of that asset as we see fit. But a foreclosure sale and REO, we still have a potential profit, and with deed in lieu and with settlement with profit. So a lot of these, there's potential profits, and that's why we have our LTVs so designed to be so advantageous for us that in case there is a loss, we might have a good deal in our hands.
Yeah, it's the other parts of our business that are able to support us in the event of a REO. where we have brokerage and we have property management, we have vendors, and we have all the people to fix and complete projects. So we're in a good spot in the event. It's not our goal, it's not our business to foreclose or to have to do that, but in the event we have to, we will, and we have.
Absolutely. We've touched upon this real quickly, but this just illustrates the diversification of the mortgage fund. These are all active and completed mortgages. So far 294 total borrowers, $73 million in unpaid principal. So this is just the diversification. You can see we've got I think it's, if I've counted it, it's like 23 states or something that we've let in. So yeah. And Vince, I'd love you to cover just some important portfolio metrics as of October 1st, since our last quarterly update.
Yeah, so you'll see here, Marshall Reddick is well diversified. There's no single capital partner or loan that represents more than 10% of the portfolio. That's by design. We definitely want to make sure that we're not overexposed in any one market or to any one borrower. So you'll see the breakdown here for the states as well as the loan amounts and those percentages that correlate.
Yeah, and I really just want to hammer home the point that single family home is our bread and butter when it comes to lending. That's, for us, we believe, the safest, most liquid asset and tradable asset. And this is kind of like the $276,000 average loan amount is sort of like that typical first-time home purchase, which is the most active tradable investment within the single family market. So we really believe that this is what we want to focus on long term, not necessarily luxury single family flips, things that might have a little bit more risk attributed to them.
Yep. And then really quick, some important metrics. We've reached 306 capital partners, 34 of which are Marshall Reddick staff. It's a really proud kind of thing to share that's how many members of the staff are involved in the fund. With just over 60 million, 5.4 million is from staff, practicing what we preach. We're putting our money where our mouth is. 252 mortgage investments, 80% are single family. And again, that 62% LTV is very, very favorable. Okay, guys, so to quickly go into the returns, right? So what are the quarterly returns? So this is, again, all on our website. We have from our very first distribution all the way until last quarter, our returns from 2020. So what you'll see is, as I mentioned earlier, we'll take a Q1 2020, for example, but we'll just break this down. Basically, what this earnings represent is net earnings after our asset management fee and after any operating expenses. So net return is 2.5% a quarter. So the way that breaks down for our partners, right, is they're always there's a 6% preferred return, which when you break that down per quarter is 1.5%. So 2.5 minus 1, and then minus 1.5 for the partner, you're left with 1%. Assuming that you're in a capital position of under 500,000, that profit share is 50-50. So you'll see how the Marshall Reddick would get 50% of that, and then the partner would get the other 50%. So that turns into 1.5 plus 0.5% is 2% for our capital partner and 0.5% to Marshall Reddick. So you can take that logic and that math all the way through Q3, and that's how that's broken down. And you'll see there's relatively very consistent flow all the way since inception. So we feel really good about that and really strong, and our last couple quarters have done great.
Well, what's new for the mortgage fund? Well, this is a really cool introduction of how we can help our clients that have a larger position in the fund achieve greater yield through a higher profit split, depending on your position, right? So for those of you that have less than $500,000 in the mortgage fund, we're going to remain at 50% profit split. So if we took all of 2024 Q1 through Q3 and blended that together, that would leave you right now at an 8.1% annualized return if you have less than $500,000 in the mortgage fund. But if your position increases above 500,000, then we provide you with a higher profit split. So it's 60% instead of 50. And that's obviously a higher return at 8.63%. We have a couple of big players in the fund at 3 million and above. That profit split would be at 70%. So that would be just over a 9% return based on our performance in 2024.
And again, that's net. That's net after all expenses. So just to be clear, you're not that's not backing out anything else.
Yeah, absolutely. This is net to the investor in the fund. So just to reiterate, $60 million of total investor capital raised thus far, 300 capital partners, 34 of which are staff. So over 10% of staff are invested in the fund, which is great. Not 10% of staff, but 10% of the total capital partners are staff. And I'd love for you to illustrate what's ahead here for the mortgage fund.
So really quickly, as we close out here, so what's ahead? It's basically a business as usual. We want to continue our steady capital raise towards 100 million. We want to continue to grow at that, slow and steady pace to be able to issue those distributions that we've had over the last 4 years.
And one thing to note, just because we hit 100 million, it doesn't mean that's the dissolution of the fund or end of the fund or anything like that. It's just a target that we set out back in 2020 and something that we've just been climbing gradually towards.
How are we going to go about this, Chris? What is it that we're going to do to kind of achieve that?
Yeah, it's focusing on those short-term loans on that single-family asset class. And now the reason why we love short-term loans is it allows for us to be nimble with changing rate environments in the private lending space. So that way we don't have all of our capital allocated on long-term loans. We're getting money back every day. We're redeeming funds on loans, and we can adjust as necessary and increase our rates to perform or provide better yield to our capital partners. It also allows on shorter term more frequent origination or extension fees. It's a big piece of the yield. You'll notice that we might charge 10% interest rates on short-term loans, but 2%, an additional 2% on origination fees. So 20% of the fund's yield is on origination fees. So the more that we're getting originations in and out, that's a lot more capital or a lot more profit from the fund. I'm curious how you would describe the liquidity aspect of the fund, and how we would use that for our clients.
Yeah, so having these short-term loans is really important too, because for those that are looking to redeem, right? When it comes time to maybe take capital out, reinvest in something else, or start to live on it, right? This is all retirement money. There is time sometimes where people, it's time to live on it. Our liquidity process is very simple, and having those short-term loans allows us access to capital to issue those liquidations. So that's been a huge component and really helpful for a lot of our investors.
Yeah, that allows you to we have a 1-year hold period initially, but after that, it allows you to get that money back within
90 days.
90 days.
Yep.
Yeah. And Vince, how do someone get started if they're interested in getting involved in the mortgage fund?
Yeah, first order of business, book a consultation with Chris or myself. We're happy to walk you through all of these steps that you see below. Of course, get accredited. We'll give you access to the portal, subscription agreements, and then deposit capital. But nonetheless, what you want to do is set up a consultation with us. Ask Ramez how he can, get in touch with us. But it's basically starting with a conversation with one of us.
Yeah, take a picture of this if you want to start a conversation. It's also on the IRA Club's website and, of course, on Marshall Reddick's website.
Thank you, guys. Always a pleasure.
Till next time.
Thanks, guys.
Take care.
The information contained herein is intended to help the viewer successfully navigate common IRS and Department of Labor requirements to help achieve successful results from their IRA. The information is not intended to replace information from your legal counsel or income tax professional. IRA Club does not offer or sell any investment. All investments have risk.